Hi everyone, my name is Piterpakulski. Today we will continue building financial model for a Uber, Lyft, taxi business idea. And today we have a very important topic to discuss, to cover. This will be a cash flow statement building. So we need some environment where we will be able to see the cash generated by the business at this or that moment of the timeline of your business idea. We need to see somewhere the result from operating activity. We need some environment where using which we will be able to calculate simple discounted payback period. So we need this environment, and this environment is mostly a cash flow statement. And today we will be building this very important table. I will be doing it from scratch. So if you find this video valuable, you may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video I will give you the link to the playlist where I will be keeping all these tutorials. And when I finish this model, I will give you all the links in the description of this video as well, so you may watch them one by one from the very beginning. So first of all, let's see what we did before. So for example, we have 5 cars in our fleet, so we can just copy these cells and create 10, 15, 20. I created just 5. So these are our cars in our fleet. This is the tab where all inflows and outflows from these cars are gathered. And if we look at the first yellow tab, let's look at it as an example. So blue cells are our inputs. So here we have different types of trips. We can specify the mileage of each type of trip. We can specify duration of this trip. We can specify the revenue from this trip. We can switch on and off this trip from calculations. We have some coefficients, global and local, for the mileage, for duration. This will be vital during future scenario modeling, when we will build the cash flow, when we will prepare net present value numbers. So then we are moving to a typical week and describe how many trips will be made on Monday. So these are the trips types, these are the amount of trips, these are local coefficients. For this amount of trips we can switch on and off different types of trips. This is the portrait of Monday. This is the portrait of Tuesday, and we have a typical week portraits too, so we can specify what types of trips we make.
Then we have inputs area where we can switch on and off different days inside the typical week from calculations. We can increase or decrease the amount of trips for each day of the typical week. And we can assign some limits for daily mileage or daily duration when we are online, to make us be operating in the world of realistic numbers. So then we specify how fast we are reaching the target revenues from the moment when we start operating activity. Then we start talking about the car itself. So we assume, for example, that we're going to sell this car when this car will become old, when it reaches 300,000 miles on the odometer. The price of new car will be $35,000. The price when we are going to sell it will be $6,000. The down payment for the loan for this car will be 10%. The interest rate will be 7%. The term of loan
will be 12 months. So we can adjust all these blue cells the way we want. Then we have global coefficients for dealership maintenance, and we have global coefficients for parts costs. So for dealership maintenance, we can specify the odometer values and the cost of dealership services when we have this or that mileage on the odometer. So this is the dealership service maintenance. Then separately we have costs for parts. So this is the month of operating activity, the number of months for operating activity. And here on the right there is the cost of service, of parts, sorry. Then we have an investment plan for this car. So these are the investment item. This is how much we invest in, and this is when we are investing in, before we start operating activity for this particular car. Then we are talking about fixed expenses. So these are the fixed costs, and here we have the typical year. And if these fixed costs have some seasonality, we can specify the seasonality inside this area. Here we have local and global coefficients for these costs. And if we would like, for example, to switch off some fixed costs from calculations, we can do it here and see what will be the financial efficiency of our business idea if we switch off this or that fixed cost item. Then we start talking about payroll for this car. So we assume that we may have up to 3 drivers, and here are their salaries. And here before that we were talking about gasoline expenses, Uber, Lyft commission, and as I already told you, payroll. Then we are moving to model, and here we have we can specify the first year of our horizon of our projections, and here are 5 cars, 1, 2, 3, 4, 5. We can switch on and off each car from calculation, or we can specify when each car starts its operating activity, and here we can specify what type of financing does each car use, loan or own funds. Then we have a switcher for management company, whether it exists or doesn't exist. These are management company payroll. So this is the position. This is the salary per person on each position. This is the amount of people on each position inside the management company. This is the management company fixed costs. So these are the articles, and these are the monthly payments for this or that fixed cost item. Then we have investment plan for the management company. So these are investment plan items, and here are the values of how much we invest in and when we invest in before we start operating activity. Then we move to loan. So here we can specify whether we would like to look at this loan independently in timeline. For example, we can specify manually when we are getting this loan, month and year, or we can link this loan to the moment when management company starts operating. So this can be automatically linked if we start moving the project from left to right. Here we can specify the amount of loan, interest rate, term of loan, grace period for principal payments, grace period for interest payments, and if we have a loan that is independent, we can specify here when we get this loan if it is not linked to the management company. So here we can specify when this independent loan occurs, so year and month. And now let's start building the cash flow statement. So first of all, let's create the timeline for the cash flow. So let's start from revenues. So our revenues will consist of two inflows, the revenues plus the moment when we are selling an old car. So our revenues will be linked to this green cell and this green cell. Now let's extrapolate these formulas to the right. Now let's move to direct costs. So as you can see, we are not putting the inputs right inside the cash flow statement. So cash flow statement is 100% automatic table, because if we put something manually inside the cash flow statement, when we start building scenarios, we will forget what values we put there, and we will start multiplying mistakes if we display some project timelines, and this will create and multiply different types of mistakes. So that's why cash flow statement is 100% automized storage, so we're not putting manually any data. So direct costs will be, so we're going up. Purchasing a new car, it is investment, down payment, financing activity, loan, dealership maintenance. We are putting here dealership maintenance. What else? Parts. So we're just searching for all red lines, red and green lines. Red for costs, greens for revenues. So then we are searching for parts. Then did we cover parts? Just a second. So parts, they do exist already. What else? Parts, primary investment plan, fixed costs, gasoline expenses, then commissions for Uber and Lyft. Okay, now let's extrapolate it. Then let's add fixed costs. So fixed costs will consist of two parts. The first fixed cost the first part is are fixed costs linked to the cars, and the second fixed costs, these are management company fixed costs. Now let's extrapolate it. Then we are moving to payroll. Payroll will consist of two parts as well. So this is the first payroll linked with cars, linked to two cars, and the second payroll, oh, just a second. This is the management company payroll. So this is the payroll. So we have revenue, direct cost, fixed cost, payroll. Then we are moving to taxes. So for taxes we will create a new block of inputs. This will be tax. Here will be the rate. So for example, this will be revenue tax. This will be payroll tax. Then we will have profit tax and asset tax. So here I will put the rates. So these will be the inputs. So I'm coloring it with blue. So revenue tax, for example, will be 4% rate, payroll tax will be 7%, profit will be 3%, asset tax we will pay, for example, $2,000 monthly. So the taxes, I will place their names here on the left. So revenue tax, I will take revenues and multiply it on this value. I will freeze this cell. Then we are moving to payroll tax. Let me just a little bit adjust the formula here, because here so we need to extrapolate the story. Let me check it. So payroll tax will be payroll multiplied the tax rate. We are freezing. We will skip profit tax for now. Asset tax, we will take this value. And for the second component, we will go to the project timeline, management company timeline. So we will link asset tax to this line. So as you can see, we are not pasting any manual data inside the cash flow statement. We were using only formulas here. So if we want to displace the project in timeline, we can easily do that. So we are moving to the first important line. So this is the result from operating activity. So the formula will be very simple. So we'll take revenues minus direct costs minus fixed costs minus payroll minus taxes.
Now let's move forward. So investment. So investment will consist of several components. The first component is primary. So first of all is down payment, loan payment, purchasing a new car. First component. Then primary investment plan, the second component, and the investment plan of management company. So I have three components. So now let's extrapolate these lines. Investment I will highlight with blue. Then I will create the second yellow line. This will be the result from
investment activity. I will take minus and add it to this line, because in our case all investments we have as an outflow. We don't have inflows inside investment activity. So this is the story about the investment plan.
Then we are moving to financing activity.
So let's say this will be equity. In columns, let's write our money. Then we will have, let's go up. So purchasing a new car, down payment. Then we will be adding down payment. Then we are using down payment, then loan payment. Then primary, fixed, Uber, pressing enter. Then let's add the loan that we were creating beforehand, principal payments, interest payments, and the inflow of this loan we will be putting here. So investment interest payments added, principal payments added, loan inflow added, else fixed, down payment for the cars, loan payment for the cars added, then extrapolate this formula to the right. So here will be perhaps the only blue line for inputs, where we will put our own amount of money that we are going to invest in our business idea, and after putting our money inside this line, we will be able to see money is not enough, and we will start scenario planning
with using different combinations of parameters. So a new stage will be started. So now we're just preparing our instrument for scenario play. So this is the equity, and here will be the last yellow line. This will be result from financing activity.
and this will be equity plus inflow minus down payment minus loan payment minus principal payment minus interest payments. Now let's extrapolate this formula to the right. Now let's start. So when we added all this stuff, we may start calculating profit tax. So we'll write the if formula. So if revenues minus direct costs minus fixed costs minus payroll minus revenue tax minus payroll minus asset tax minus this minus just minus this minus down payment minus this minus principal payment minus interest payment. If this value is less than 0, we will put 0, otherwise we will take this tax base and multiply it on the tax rate, profit tax rate, and then we will close the bracket. Now let's press enter, and now let's extrapolate this formula to the right. Okay, so now let's add cash balance at the beginning of period and cash balance at the end of the period. This will be the end of the cash flow statement. So here we have 0, then cash balance at the end of the period, we will have result from operating activity plus the result from investment activity plus the result from financing activity plus cash balance at the beginning of the period. Then this ending cash balance becomes the starting balance for the next month. This cell we are extrapolating to the right, so the formula will be operating investment financing plus the beginning cash, and now we will just extrapolate this formula to the right. So now we are done with our cash flow. We can hide these lines Now let's press 1. Here we have grouped cash flow statement. And now everything is ready for financing calculations. This will be the topic of our next video. So I hope you enjoyed this video. You may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video I will give you the links to the playlist where I will be placing all these tutorials. And when I finish this model, I will give you all the links on these tutorials in the description of this video as well, so you may watch them one by one absolutely free from scratch. So thank you guys for watching. See you next videos. Thank you and bye.